When most people hear about turning $1,000 into $50,000, they imagine risky bets, quick profits, or luck. But the truth is very different. The real secret is starting with what you have, even if it feels small, and building a strong plan that allows your money to grow safely. $1,000 may not look like much, but when it is placed carefully into the right opportunities, it can become the foundation for a much larger future. Small investors often think they need huge capital to begin, but this mindset can hold them back. History shows that many successful investors started with very little. What made the difference was discipline, patience, and the ability to see beyond the present moment. By thinking big, you remind yourself that today's small steps will open doors to tomorrow's big rewards. The goal is not to chase every flashy stock or risky trend. Instead, it's about steady moves, like setting clear goals, understanding where your money goes, and using proven strategies that keep risks low. $1,000 is not just money. It is your ticket to learn, grow, and practice smart habits. When you think big while starting small, you create a mindset that focuses on the long game, turning small wins into lasting success. Know your money goals before you invest a single dollar. You need to know exactly what you are aiming for. Money without purpose often gets wasted, but money with a clear target grows with direction. If your goal is to turn $30,000 into $50,000, you must first ask yourself, how fast do I want to reach this? Am I building wealth for the next 5 years, or am I preparing for a longer journey, like retirement? The answer will shape the choices you make. Having money goals also keeps you focused when the market feels uncertain. For example, if your aim is steady growth, you won't be tempted to risk everything on quick bets. Instead, you'll look for safer investments like index funds, dividend stocks, or savings plans that match your timeline. Goals act like a map. Without them, you might move in circles, but with them, every step you take has meaning. Small investors sometimes skip this step because they feel $1,000 is too little to plan for. But that's the mistake. Even with a small amount, a clear goal helps you decide how much risk you can handle and what path is best for you. The key is to write your goals down, whether it's saving for a home, creating passive income, or growing long-term wealth. When you know your money goals, your $1,000 is no longer just cash. It becomes a tool with a mission. Safe ways to grow fast. Many small investors dream of fast growth, but fear losing their money in risky choices. The truth is, you can grow quickly without gambling everything. The key is choosing safe paths that balance speed and security. One proven way is to use compound interest through reliable investments like index funds or high-yield savings accounts. These may not feel exciting at first, but over time, the growth adds up faster than you think. Another safe option is dividend-paying stocks. They reward you with regular income while your money keeps growing in value. Reinvesting those dividends is like planting seeds that multiply, making your $1,000 work harder every year. Exchange-traded funds (ETFs) are also a great tool because they spread your money across many companies, lowering risk while keeping returns steady. It's also smart to avoid debt-heavy moves, like borrowing money to invest. Fast growth doesn't mean reckless choices. It means making steady decisions that protect your money while letting it grow. Think of it like building a strong house. The foundation takes time, but once it's set, the structure rises quickly. By focusing on safe growth methods, you don't just protect your $1,000, you give it the power to multiply again and again. Fast doesn't always mean dangerous. With the right strategy, you can grow quickly while keeping your future secure. Power of saving early. The biggest advantage a small investor has is time. When you save and invest early, even with just $1,000, you unlock the power of compound growth. Every dollar you put aside today has the chance to multiply tomorrow. For example, if you begin now, your money earns returns, and those returns start earning their own returns. Over the years, this snowball effect turns small contributions into life-changing amounts. Many people wait, thinking they will save more later when they earn more. But waiting is the costliest mistake. A person who starts with small amounts early can often end up with more than someone who invests larger sums but begins late. The difference is not how much you put in, it's how much time your money has to grow. Saving early also builds discipline. It trains you to live below your means and prioritize future wealth over short-term pleasures. When you learn to save, you also learn patience. And patience is one of the greatest strengths in investing. Even $50 saved regularly can change your financial story if it's given time. Think of your first $1,000 as a seed. The earlier you plant it, the stronger and taller it grows. By starting now, you don't just aim for $50,000. You set yourself on a path where money works for you instead of you always working for money. Smart investing steps. Turning $1,000 into $50,000 doesn't happen by chance. It happens by following smart steps. The first step is research. Before placing your money anywhere, take time to understand where it's going. Learn the basics of stocks, funds, or savings options so you don't invest blindly. Knowledge protects you from costly mistakes. The next step is diversification. Never put all your money into one place. Spread it across different investments such as stocks, ETFs, or bonds. This way, if one drops, the others can balance it out. Think of it like not carrying all your eggs in one basket. It lowers risk and builds stability. A third step is consistency. Adding even small amounts regularly strengthens your position. For example, setting up automatic contributions ensures you grow your wealth without forgetting or skipping. Over time, steady investing often beats risky one-time bets. The final step is patience. Smart investing is not about chasing quick wins. It's about building a habit, following your plan, and trusting the process. If you stay disciplined, your 30,000 can grow steadily toward 50,000. By following these steps, research, diversify, stay consistent, and remain patient, you give your money a clear path. Smart steps may look simple, but they are the foundation of big results. Risks you must avoid. Growing your money is exciting, but without caution it can turn into a painful lesson. As a small investor, your first job is to protect your 30,000 from common mistakes that destroy progress. One of the biggest risks is chasing quick profits. Many people fall for hot tips, trending stocks, or social media hype. These often rise fast and crash even faster, leaving you with losses instead of gains. Another risk is putting all your money into one investment. Even if it seems safe, nothing is guaranteed. A company could fail, a market could drop, or a new law could change everything. That's why diversification is not optional. It's essential. It spreads risk and gives your money more chances to grow safely. Emotional investing is another hidden danger. Fear and greed are powerful. When markets go down, people panic and sell at a loss. When prices rise, they buy too late, paying more than they should. A smart investor learns to stay calm and stick to the plan, not the headlines. Also, never invest money you can't afford to lose. Don't use your emergency savings or borrow to invest. Debt adds pressure and increases your risk. Avoiding these mistakes keeps your journey safe and steady. Protecting your $30,000 is just as important as growing it. When you learn what not to do, you're already halfway to success. Building steady income. One of the smartest ways to grow your $30,000 is by creating steady income through your investments. Instead of hoping for big one-time wins, focus on assets that pay you regularly. This builds financial strength over time. Dividend-paying stocks are a great example. These companies share part of their profit with investors every few months, allowing you to earn while still holding your investment. Another option is real estate investment trusts, REITs. With as little as $100, you can invest in REITs through certain platforms and receive regular income from properties like offices, apartments, or shopping centers. This is a powerful way for small investors to join the real estate world without buying a whole property. Peer-to-peer lending is also growing. It lets you lend your money to others and earn interest, like a mini bank. But be sure to choose only trusted platforms and understand the risks. The goal is simple: let your money bring more money. The small income may not feel huge at first, but as it grows, it can be reinvested to speed up your journey to 50,000. Steady income gives you peace of mind. Even if the market slows down, you still earn. It turns your 30,000 into a working tool, earning, growing, and pushing you closer to financial freedom every day. When to take profits. Knowing when to take profits is just as important as knowing where to invest. Many small investors make the mistake of holding on too long, waiting for the perfect price. Others sell too soon, out of fear or excitement. The smart move is to plan your exit just like you planned your entry. Start by setting profit goals. For example, if your 2,000 investment grows to 2,000, you might choose to take out your original amount and leave the rest to grow. This way, you've locked in gains while still staying invested. Another method is rebalancing. As your investments grow, some may rise faster than others. If one area becomes too large, you can sell a part of it and move the profits to something safer. This keeps your portfolio balanced and protects your gains. Timing also matters. If your investment reaches a major goal or the company's future no longer looks strong, it might be time to cash out and look for better options. But avoid selling just because prices drop, unless the reason behind the drop is serious and long-term. Taking profits isn't about fear. It's about being in control. It's how you protect your wins and use them to build more. Remember, profit is only real when it's in your hands, not just on a screen. Path to 50,000 success. Turning 1,000 into 50,000 may sound like a dream, but with the right steps, it becomes a real goal. The journey won't be fast or easy, but it is possible through planning, patience, and smart action. You've already learned the core ideas. Start small, set clear goals, Invest wisely, avoid risky mistakes, and build steady income. Now it's about staying committed to the full journey. Success doesn't happen in one big leap. It's a series of small wins that stack up over time. Maybe you grow your money to funders 500, then 3,000, then 10,000. With each level, your confidence grows, and so does your capital. Keep reinvesting your gains, adjusting your plan as needed, and learning along the way. Also, track your progress. Celebrate each milestone, no matter how small. This keeps you motivated and focused. Avoid distractions and don't compare your path with others. Your journey is unique. Even when markets slow down or your growth feels stuck, stay on course. The people who succeed are the ones who keep going when others give up. With discipline and time, your 10,000 can grow beyond what you imagined. This is the path to 50,000, not by luck, but by steady, smart decisions. And the best part, once you reach it, you'll know how to do it again.